Welcome to our second lecture of the week as we continue our look at America in the Great Depression, and particularly in the early to middle part of the Great Depression era. Today we will look at President Franklin Delano Roosevelt's first years in office, in particular the legislation that he and policies that he drove through to combat America's financial crisis. These series of acts and legislation and policies are known collectively as the First New Deal. And we will also examine today a look at the specific policies that were intended to stimulate recovery in America's agricultural and industrial sectors. So we will begin today by taking a look at the First New Deal. And as we discussed in our previous lecture, the election of 1932 took place. Herbert Hoover, seeking a second term of office, was very unpopular across the country. He also did not project a very confident public image. And as a result, Franklin Delano Roosevelt, the Democratic nominee, governor of New York at the time, was able to defeat Hoover and win the 1932 presidential election. Roosevelt took office in March of 1933. Interestingly enough, if you're a presidential historian buff or a presidential trivia fan, that was the last presidential election in which the inauguration ceremonies were held in March rather than January 20th, which, of course, is when we currently inaugurate a new president. So the 1932 election and the transition from Hoover to Roosevelt in the spring of 1933, officially taking place in March of 1933. That was the last time that America inaugurated a newly elected president outside of the month of January and outside of the specific date of January 20th. Anyhow, that's just a little historical trivia nugget for you. But taking a look at Roosevelt and what he did when he took office, again, the economy is in free fall. It has been for years. The American public has no faith in the stock market. They don't have any faith or confidence in banks. We discussed how many banks had failed over the last few years, from when in the time between Black Tuesday in October of 1929 and the end of 1932, beginning of 1933. It was approximately 9,000 banks across the country that closed. So Americans literally had the notion that whatever money they had, whatever cash or savings they had, they believed, quite a few of them, that it was safer to keep it in a jar buried in their backyard, or keep it stashed underneath the mattress in their bedroom, than it was to deposit it into a bank account or a savings account at a bank. So that was something that Roosevelt obviously wanted to overcome, and he wanted to restore America's faith in banks and get the financial sector of the American economy back in gear and going so that it would become functional and operational for America going forward. The first thing he did was declare a bank holiday. Almost immediately after the inauguration was over and he officially took office, he declared a bank holiday. All of the nation's banks closed for several days, close to a week, while Roosevelt and some of his policy advisors examined what steps they needed to take in order to revitalize the banking industry. Along with Congress, Roosevelt helped pass and enact an Emergency Banking Act during this time period. The Emergency Banking Act put tighter guidelines on banks, and Roosevelt, on March 12, 1933, days after he had become president, gives his first meaningful presidential address as he addressed the nation via radio. And in that radio address, he explained the policy regarding the Emergency Bank Act and reassured the American public that banks were safe, secure, and legitimate places in which they could store their money for safekeeping, for savings. This radio address was the first of many radio addresses that Roosevelt would deliver over the course of his lengthy presidency, in which he would talk directly to the people and give them, explain to them in detail the legislation and the policies that he was promoting and how it would impact Americans as a whole. And these addresses became known as fireside chats because Roosevelt spoke in a very easygoing manner. He did not bog the listening audience down with really arcane policy jargon and terms, but explained it in a very straightforward, very accessible way in which common Americans could understand it, and he did it with a pleasant disposition in terms of his tone of voice and his delivery style. So it sounded more like an informal conversation in which the president was telling you, the individual sitting at home listening to your radio, exactly what the latest congressional legislation that had passed was all about, and how it would impact you and your fellow Americans. That was basically what the fireside chats were. It's interesting that Roosevelt was so effective with fireside chats because his distant cousin, Theodore Roosevelt, who was president several decades earlier in the early 1900s, Theodore Roosevelt is seen as sort of the first president to really take advantage of the spotlight in terms of using it to persuade Americans to go along with his policies. What we discussed when we discussed Theodore Roosevelt earlier this semester in his presidency, we talked about how he seized the bully pulpit, and the bully pulpit was the fact that the President of the United States could speak publicly, and the media and the press would air his comments either through newspaper articles quoting him directly, or by the time Franklin Roosevelt became president in the 1930s, he could speak just directly to a radio audience without the middleman of the individual reporters, and get the message across. So the idea that Americans could be persuaded via presidential address that sort of first came to fruition, if you will, during Theodore Roosevelt's presidency, with speeches and using the bully pulpit to his advantage, and his distant cousin Franklin Roosevelt sort of perfected it for a new era via the fireside chats and radio addresses. In later decades, we will see, I should say, presidents that use the bully pulpit with regard to television addresses, televised speeches, where they're speaking directly to the American people. That's sort of the next phase of this bully pulpit, bully pulpit advantage that you have as the president. You can talk to the American people whenever you want, and the public will find out either from the media through newspaper articles or news reports on radio and later television, or if it's address that is directed explicitly to the American people. Oftentimes nowadays TV networks will air that address uninterrupted. Back in the 1930s when Roosevelt took office, radio networks aired the fireside chats uninterrupted. Anyway, getting back to the Emergency Banking Act and financial policy during the early years of the Roosevelt administration, Roosevelt basically in this fireside chat pleaded with the American public to put money in banks, deposit money in banks. It was safe, it was secure, and they had nothing to fear by doing so. And then I think he explicitly stated that it was much safer to put the deposits in the bank rather than keep it between your mattresses or underneath your mattress in your bedroom. And the public, this message resonated with the public because when banks reopened a day after the fireside chats, deposits exceeded withdrawals nationwide in banks for the first time in several years. Over the course of Roosevelt's first 100 days in office, he persuaded Congress to pass more than a dozen pieces of legislation, many of which went directly to aiding the financial sector of the economy. One of them was the Glass-Steagall Banking Act, which established what we know today as the FDIC, the Federal Deposit Insurance Corporation. What the FDIC does, you probably, if you've walked into brick and mortar branches of banks, you've seen the FDIC logo on the door, or you've perhaps heard an advertisement for banks on TV and radio, member FDIC. It means they're part of the Federal Deposit Insurance Corporation, which was created through the Glass-Steagall Banking Act of 1933, part of the First New Deal. And what the FDIC does is it insures your individual bank deposits. When it first came into existence in 1933 as a result of this legislation, the FDIC would insure bank deposits of up to $5,000, which meant that if you were an American citizen in 1933, 1934, 1935, and say you put $500 in your bank account in a deposit, the FDIC ensured that that money would be there for you. So if the bank for some reason closed or ran out of money, the federal government would reimburse you for the $500 that was in your account at the time. You would not lose the $500 in the unfortunate event that maybe a bank closed or something like that. The FDIC, as I mentioned, is still very much a part of the banking industry today. They have upped the amount of the insurance for personal bankers so that today, in 2021, the FDIC insures deposits up to $250,000. So in a personal bank account these days, if you have $250,000 or if you deposit $50,000 into a savings account at a bank that's an FDIC member, and the overwhelming majority of American banks today are members of the FDIC, then you can rest assured that your money is insured by the federal government. In other words, that's basically what the FDIC provides for individual Americans. In addition to the establishment of the FDIC, the Glass-Steagall Bank also separated banks into two different categories. Commercial banking was split up from investment banking. prior to the Glass-Steagall Act, banks often operated with a commercial banking sector in which individuals would deposit money in checking accounts or savings accounts, or would come to the bank in search of a loan for buying a home or starting a business or whatever. But there was also another segment of the bank that was an investment segment, an investment sector of the bank, in which people would invest money and the bank would invest in stocks and securities. And as I mentioned in the late 1920s, that stocks and securities and the stock market was becoming increasingly speculative. People were taking more and more risks, particularly brokerage houses and investment banks. So with Glass-Steagall, this new piece of legislation basically required commercial banks to refrain from providing or offering investment banking services, and investment banks could not offer commercial banking services. And as a result, that made it far less likely that the commercial banks would fail if they didn't have some of these risky speculative investments in securities that had become very prevalent in the late 1920s before the Black Tuesday stock market crash. Also, as a result of this legislation, there were overall more regulations and tighter regulations of Wall Street through the Federal Securities Act, and there was an establishment of a new government agency known as the SEC, not the Southeastern Conference that the University of Mississippi and other schools are members of, but rather the Securities and Exchange Commission. It's a government regulatory agency that sort of regulates the stock market and securities trading, and it still exists today. The Federal Securities Act and the creation of the SEC, along with Glass-Steagall and the bank holiday, these were all policies that FDR pursued and was able to get passed and accomplished within the first 100 days of his presidential term to stimulate, for lack of a better term, the financial sector in America. So now I want to shift gears a bit and move from talking about banks and financial securities and the financial sector of the economy to relief organizations and providing a relief directly to the American people. In one of our recent lectures, I discussed how the Hoover administration was very reticent and frankly reluctant to the point of refusing any direct relief to American citizens. Hoover offered public reassurance in his speeches, encouraging Americans to remain confident, to volunteer. He established POOR, the organization that coordinated private charitable organizations to effectively provide relief to American citizens. But in terms of the government itself spending money to aid American citizens, the Hoover administration did not want to do that, and ultimately they did not do that to a significant degree at all. And that is part of the reason why the Great Depression continued throughout Hoover's presidency. When FDR wins the presidency, he decides that the government needs to stimulate the economy, and part of that is to reduce the unemployment rate of America and give Americans jobs. with federal funds so that they can survive this economic crisis. So the first of several job programs that FDR established upon taking the presidency was the Civilian Conservation Corps, the CCC. This was a federal agency that provided jobs for men, young men between the ages of 18 and 25. The overwhelming majority of these jobs, pretty much all of them, were blue-collar type of jobs that involved a lot of work outdoors, such as building and maintaining bridges, recreational areas, campgrounds, and other sort of outdoor labor type work that young men could do, and by doing so, they would receive federal paycheck, and there were federal employees that were overseeing and directing these young men on the various labor tasks that they were assigned to do. That was almost immediately initiated during the first months of Roosevelt's presidency in 1933. Also, in addition to the Civilian Conservation Corps, another organization, the Civil Works Administration, or CWA, was established, and it also ultimately served as a jobs program specifically for people seeking work during the winter of 1933-1934. This was not an organization that lasted very long in America. It only was around for roughly 4 months, from November of 1933 through January, February of 1934. But it basically allowed individuals to get jobs and to keep jobs through that 3 to 4 month period at the end of 1933 and the start of 1934. Some of the jobs involved repair work on federal highways, construction projects with regards to airports and particularly schools, and also quite a few of the jobs were teaching positions in schools, especially schools in rural America. 50,000 teaching jobs were created through the CWA, almost all of them in rural schools, and that was specifically so that rural schools would remain open in the middle of the Great Depression. They wanted to do whatever they could to keep the schools open and to keep students in school, and this jobs program enabled the schools to have the workforce available to keep the schools open for that period during the school year, and sort of get these schools through a rough patch during the height of the Great Depression. Nearly a year and a half after the CWA, in 1935, a much larger, similar jobs initiative was created called the Works Progress Administration. The Works Progress Administration was an organization, that's sort of a large umbrella organization, if you will, that had a number of jobs programs that were part of that Works Progress Administration. So if you think of it, these other programs were sort of individual divisions or departments within the larger Works Progress Administration. Congress authorized nearly $5 billion to establish the Works Progress Administration in 1935. One of the significant divisions within the Works Progress Administration were jobs that were created for artists and writers of the era. The Federal Writers Project, the Federal Theater Project, the Federal Art Project, the Federal Music Project, and these jobs enabled America's writers and musicians and other artists to continue working and to continue to get paid during this economic downturn by federal money. And one of the real benefits of these specific job programs, particularly the Federal Writers Project, was that writers, researchers were able to use the program and the funds from the program to interview older Americans. And in particular, they interviewed surviving slaves. And by the mid-1930s, most of the African Americans that had been born into slavery or had spent their early years as a slave, of course, had died and were not alive during this time. But there were still some former slaves that were still alive during this period and cognizant mentally, and the writers from the Federal Writers Project interviewed them and basically produced oral histories of concerning the memories of slavery and Reconstruction. And there are several historical works that cite these oral history projects. It's how we sort of get a window as to what slavery was like, literally from the mouths of people that once were slaves. They share their memories in an oral history project funded by the government, and that has been examined and researched by subsequent generations of historians. So we have an idea of, for example, what it was like for an individual to work as a slave and then all of a sudden, after the Civil War ended, to become a freed person, but take a job as a paid employee for the family that had previously owned them as a slave, and what the dynamics were when they, in that sort of tricky transition between slavery and freedom. That's just one of many things that we've learned about the era of slavery and Reconstruction that followed it through the Federal Writers Project. So pretty significant part of the Works Progress Administration, kept writers and artists and musicians employed during a time where it would have been difficult for them to find a market for their work elsewhere. That's all part of the Works Progress Administration. In addition, another organization, another division, if you will, of the Works Progress Administration was the National Youth Administration. The National Youth Administration provided part-time jobs for students and also jobs for unemployed youth. So if you think of it, during this time period, if people who were college students like yourselves, when the school year ended, or perhaps even in the middle of the school year, you might really your family might be in a situation where you're not really sure if you can afford to come back to school and pay tuition for school. So what you could do during this era is get a job with the National Youth Administration and spend your summer working for the NYA, doing NYA projects, and get a federal paycheck throughout the summer and use that money to pay your tuition for the next school year in college, and perhaps move from a full-time to a part-time job within the NYA, or just wait till the following summer and get another job with the NYA. And there are quite a few people that took advantage of this. The people that graduated from high school during that period and were unsure of how they could pay for college, so they got a job with the NYA, and that was able to pay for their freshman year of college. And then they went back to work with the NYA the summer after their freshman year. That covered the cost of their sophomore year of college, and so on and so forth. So there were thousands of Americans that were able to continue their education, either moving from high school to college, or if they were in college, were able to find a way to stay in college long enough to complete their credits and graduate because of the NYA, which was part of the Works Progress Administration. And in those days, a college degree, just like it is today, very valuable, and the type of credential that could get you a solid middle-class job in America, especially once the Depression ended several years later. But had the NYA not existed, perhaps many of those students might have dropped out of college or not gone to college to begin with and had just a high school education, which would have put them at a disadvantage on the job market. Interestingly enough, also with regard to the NYA, the 36th President of the United States, Lyndon Johnson, who we'll talk about later this semester, at the time, he was a young, aspiring politician. He had worked as a congressional aide, and his very first significant political job after serving as a congressional aide was with the NYA. He used some connections in Congress to get appointed as the NYA director for the state of Texas. The state director for the state of Texas is NYA, and it was his responsibility to find jobs and projects to assign to the students who were NYA employees and get those projects funded and get those workers funded. Also, another future president, LBJ's successor in the White House, Richard Nixon, at the time was a law school student at Duke University. He did not have much money, like most Americans during the time, and he accepted jobs through the NYA that helped him remain in law school and wind up being able to pay his tuition and ultimately complete his legal education and get a law degree. And of course, decades later, he became the President of the United States. So that was a look at some of the jobs programs and federal relief programs. Earlier, we discussed the financial sector improvements that FDR set about to make early in his tenure. Now I want to focus more on attempts to recover the recovery for the agricultural sector and the industrial sector of the American economy. And we'll begin with the agricultural sector of the economy. In 1933, as part of the first New Deal, Congress passed the Agricultural Adjustment Act, which established the Agricultural Adjustment Administration. And this legislation provided federal funds to America's farmers in order, believe it or not, to reduce production of their crops. And you might ask yourself, why would the government pay farmers to limit their production of crops? At the time, there was a saturation of farm products on the market, and as a result, the prices were extremely low. And in order to really get the agricultural economy jump-started and going again, the government believed that, and FDR believed that by reducing the production of the crops, that meant you would have fewer crops coming to market, which meant that the price of individual crops would raise. It would raise the prices of commodities, which would stimulate more money, generate more money in business transactions involving farm products. And in addition to reducing production in terms of limiting the crop growth, there were some farmers that were persuaded to plow over parts of their farms, plow over parts of their fields, so that they wouldn't raise as many crops, which if you think to 19th century America, and particularly antebellum America and America before the industrial age begins in the late 1870s, it would have been unheard of for Americans of that era to willingly plow over fertile farming ground and to willingly harvest fewer crops each year. But this is what the government believed was the quickest way to get higher prices for American farm products and to generate more revenue through the agricultural sector of the American economy. The money that the government used to pay farmers in order to limit their crop production came via a processing tax, which was levied on businesses that processed farm products, businesses such as flour mills, meatpacking plants, cotton gins, and the like. This was a measure that was opposed by conservative politicians, and ultimately it was overturned by the U.S. Supreme Court in 1936. The court ruled that the processing tax was unconstitutional. So 2 years later, the Congress passed the Agricultural Adjustment Act of 1938, which essentially reestablished parts of the earlier Agricultural Adjustment Act, but without the processing tax, without the part that the U.S. Supreme Court found unconstitutional. So the government was still subsidizing American farms and American farmers during this era, but no longer was a processing tax levied on businesses that processed farm products. If you take a look at the poster in the right-hand corner of this slide, you can see this is a persuasive advertisement, if you will, put out by the Agricultural Adjustment Administration. It says, "America has plenty of food for everyone," and it shows an American, presumably an American farm family, healthy, happy, together, and this is designed to reinforce the government's position that America's farmers did not have to maximize production of their crops, that there was plenty of agricultural production to sustain the country's needs, and also the government would ensure that the farmers would be able to make money and continue to earn a living via farming and maintain their individual farms during this time period. So the Agricultural Adjustment Administration, part of the Agricultural Adjustment Act, and it was a major part of trying to revitalize the agricultural sector of the American economy. Obviously, parts of it, in particular the processing tax, ran afoul of the U.S. Supreme Court, but then Congress reestablished it in a different form, and it continued into the 1940s. Shifting gears, we'll take a look at the industrial recovery for America during this time period. In 1933, again, during Roosevelt's first year as president, Congress passed the National Industrial Recovery Act, also known as the NIRA. This act created the Public Works Administration, also known as the PWA, which supplied over $3 billion for public works projects such as highway programs, the construction of public buildings, as well as building and maintaining bridges and tunnels. It was essentially a major infrastructure project for the time period. So this is yet another example, along with the Civilian Conservation Corps and the Works Project Works Progress Administration and the divisions within that, such as the NYA and the Federal Writers Project. This is another example where the government is providing funding for public works projects that would be done by American citizens, and they would receive paychecks for doing so. So this was another way of the government providing funds, relief funds to Americans in exchange for their labor, for their work to create things that the government thought were beneficial to the public at large with these public works projects. In addition to the PWA, the National Recovery Administration, known as the NRA, was established through the NIRA, the National Industrial Recovery Act. And the NRA basically was an initiative that regulated businesses during this time period. They established minimum wages, price codes, and other labor standards. Some of the things that are standard in America today, such as the 40-hour work week and minimum wage salaries. Particularly at this time, it was a weekly minimum wage of $13 a week in the North, the Midwest, and the West, and $12 a week in the South. The reason it was less in the South was because the cost of living in the South at that time was slightly more inexpensive than the rest of the country. But if you adjust for inflation, $13 a week in 1933 is roughly $260 a week in 2021 money, and $12 a week in 1933 is roughly $241 a week in 2021. So not much in terms of a minimum wage, but there was a minimum wage established and a 40-hour work week established. These were things that labor unions had fought for in the late 19th century and the early 20th century. We've discussed that with some of our conversations about the Pullman strike and the American Railroad Union and the American Federation of Labor and the Knights of Labor before that. Two very significant labor standards established by the NRA. Despite the fact that the NRA on the whole worked, it also generated criticism from a variety of factions who thought that the codes were either too strict or that certain businesses could game the system and take advantage of some of the standards and some of the price codes and wage regulation and things of that nature. And in 1935, the Supreme Court ruled that the NRA was unconstitutional. Despite this ruling, as I mentioned, several of the bedrock standards that originated with the NRA remained in effect long after it was struck down by the court, such as the 40-hour work week and the abolition of child labor, both of which still exist today, more or less. So those were big advancements in American business and labor relations through the first New Deal, even though the Supreme Court ultimately ruled the NRA unconstitutional. And Roosevelt and his staff had to go back to the drawing board to come up with other options as far as enhancing the economy and the workforce standards going forward. We will discuss that in our next lecture, which will be posted by the end of the weekend.